Hopefully that works. Test, test. Oh, I think that worked. All right, so I think that worked. I think the issue. Can I type? Can't type, so it's my computer USB port that is giving me issues. But no worries, we'll get that figured out. As long as we got the mic working, you guys can hear me, we are good to get things started. Maybe a pain in the ass to type, but we'll cross that bridge when we get to it. But thanks for tuning in, even though we had some minor technical difficulties on our very first stream of 2023. Hopefully that will be the end of the issues that we have in 2023. We've got a ton to talk about. This will definitely be a little bit longer of a stream than normal. I've got some very... Oh, we're getting some comments that there's no YouTube, but it looks like we're getting comments in on the YouTube as well. And I checked on my phone. It looks like YouTube is still working. But if you guys are having trouble checking YouTube maybe earlier, check again now. See if that works. But yeah, we are excited to get things going with a blank slate for the upcoming year. We've got a lot of good ideas that I want to run through. I think we've got a lot of cool things that we're going to implement in the new year. And without further ado, instead of just sitting here and talking to you about nothing in circles for a few minutes, let's jump into it. Go back to the standard presentation, put the webcam on in the corner, and then one new addition to our streams. How about a little white outline on the camera right here? You probably can't tell because it's on a weird background, but it is what it is. I've also pulled up a very basic little agenda for us to run down here. Very first thing before we get into general 2022 recap is let's just talk about what happened last week. Last week ended up being a great week for us from an outperformance perspective. We made about $2,600. There we go. Jules is on YouTube. She can see me. We're good to go now. But we made about $2,600 last week in the market. It's a 1.55% return. And most significantly is, yes, we always love when we have a green week, but we love it even more when we could do so when the market's red overall, right? And the S&P 500, which we measure through the ETF SPY, was down 0.13%, and the NASDAQ was down 0.3%. And that's good for relative outperformance of 1.67% against SP 500 and 1.84% on NASDAQ. But let's actually talk a little bit about how we did it, because I think it was a really, really well-managed week. And if we pop into Thinkorswim really quickly, we could pull up the SPY chart. And I forgot that I'm going to have to type over here because for whatever reason, the USB port on my laptop is messed up. But let's take a look at the last 5 days in the S&P 500, right? It was far from smooth sailing, right? We peaked at 385 at one point on, Monday afternoon. We got down to 376. The 10-point variance on SPY, especially in a 4-day trading week, is pretty significant. But we were able to overcome it, and let's go back to the positions that we had really quickly. I mean, not a lot to talk about. I mean, that's just kind of the way it is with our strategy. And when things go as planned, there isn't a ton to talk about. We didn't really have one position individually make us a ton of money. And that's exactly what we like, right? If we take a look out to the right here, we'll see that a firm made us the most money, 635. And there's some others in here which I haven't included quite yet, like Beyond and IQ and XSP. But of the HT wheel typical positions, Affirm made us the most money. Fetch made us 420, Roblox 385, and Roblox was another good one this week for us. I mean, we've just been hammering that thing week after week after week, and what I really love to highlight with Roblox is really what I love to talk about with our strategy in general, right? Roblox, we made 385 this week. 2 weeks ago on Roblox, let's see where we could find it. We made another 330, so that's a total profit of, let's see, oh, forgot the control keys over here now because it's on my laptop. But 385 last week. 2 weeks ago, Roblox, we made what? Cumulative 715, and then 2 weeks before that, we made even more, meaning we've made $1,000 on bullish Roblox trades in the last 3 weeks. And if we take a look at the Roblox chart, I've got some news for you. Over the last 3 weeks, it hasn't really done much. It's been pretty damn flat. So that is, a testament to why we do what we do, right? We had this big drop off in Roblox. We identified a high IV opportunity. We identified a decent area of support that we could have played Roblox off of. And we identified low RSI, meaning that it was a little bit oversold. We jumped in at a level that we liked, and it turned out pretty well for us. So if we pop back to the tracker, we're going to see that's, a decent source of profit for the last few weeks. But again, we never want to knock it out of the park with one position. We cumulatively build smaller positions, smaller profits, and we let those base hits stack on top of each other. And all together, they work together and bring home a really, really nice weekly profit. Now, we did lose money on a couple tickers last week. I think the biggest loss was Amazon, followed by Lemonade, but really not a huge deal, right? We are going to have losses sometimes. We're going to win a lot, but we are going to have some losses. But what's important when we have these losses, we say it every single week on here, we don't want the losses to be huge and overshadow the gains. Limiting Lemonade to 130 and Amazon to 165 was just fine, right? And Amazon's one of those trades that we've broken out to kind of demonstrate what we're doing here. And we are in a position now where our break-even price is actually 82.94. And I think if I go over here, this is annoying that my keyboard is choosing not to work tonight. But Amazon's actually at 84, meaning in the current position we have where we rolled to next week for 284 strike puts, we're actually in line to make money even though Amazon has decreased 6.67% since we entered into the trade on December the 15th, 2022. So that's what we're working with right now, and a great example of how when you identify a nice stock at a nice level with decent premium, it's a very manageable trade, right? Because we could pull up that Amazon chart and let's see what we can see here. This is not, this is very, very far from a bullish chart, right? And in spite of that, so long as for the next 4 trading days it holds around this 83, 84 level, we're going to have made money on that overall cycle, so to speak, for that trade. So a great example of running the wheel on a reliable stock. And going back to last week, spoiler alert, that's this upcoming week. But yeah, nothing really too crazy to talk about. Maybe one thing I do want to talk about is the Beyond and the IQ trades, because this was a little bit outside the norm of what we typically do, right? Especially throughout 2022, the market's been so oversold. Really just a lot of large dips that have presented good entry opportunities. We haven't really given a lot of mind to playing things back down the other way. And especially when we're trading in a market where there's a lot of spikes that are almost immediately sold off and give way to further dips. Incorporating some bearish trades into what we do, I think, is a very, very smart approach going forward, but I think we also want to be smart in the way that we do it. So let's talk about how we identified Beyond and IQ as 2 candidates right there. And while they weren't exactly home runs, right, they brought a combined profit of 145 in. And we actually rolled IQ out to next week and make a potential profit of, I think, around 400 or 500 bucks on that one if it pulls back a little bit for us. But let's take a look at the Beyond chart. We're going to see that on Thursday, there was this really, really big green candle at open. You see it right there. RSI gets really, really hot. It gets up to 85 at the peak. And we know Beyond is not the most fundamentally strong stock in the world. So as the market's running back up like this, and we always want to keep the broader indices in mind when we think about this too, right? The S&P 500 rips up from 376 to 384. That's a significant jump. That's when we start wanting to play things back down the other way. Because look, the market isn't going to shoot up or down in a straight line. There's a little bit of waviness to it, and that's exactly what we saw in the back end of Thursday and a little bit of Friday before it ripped back upwards before close. But back to the point about Beyond, right? We saw that it had run up a bunch. RSI got pretty hot, and sometimes you put yourself in a situation where you might be catching a little bit of a falling knife or maybe reverse of that when you're trying to play something back down, and it's tough to pinpoint where something is going to stop. So when we got into this, we did so with a 13 strike call. We sold it for 25 cents a premium, meaning we had a 13.25 break-even price. So anything below here, we were going to make money. And the great part about this trade is that using our knowledge of RSI, knowing that this was a little bit overbought at this point in time, and using that 13 strike call, which was slightly out of the money when we entered, I think Beyond was about 1290-ish when we entered, but it never even touched this point. So we never even had to worry about potentially losing any money on this trade. The only slight risk was taking it overnight. But by the end of the day on Thursday, this thing was down to about 1240, which left a pretty decent cushion for us to hold on and go to max profit. So that was Beyond, and a really easy trade to put down Thursday morning. That's a 36-ish hour trade, opening something Thursday morning and closing it out on Friday afternoon, or letting it expire Friday afternoon in our case. But IQ's the other one, and this one potentially could have made us a little bit more, right? We sold 10 contracts for 21 cents of premium, meaning at max profit we would have made 210 bucks. Now this is an example, Beyond didn't even touch that red line that we drew, right? We didn't even get in any danger of losing money at any point on this position. IQ is a little different story. And we like IQ to play back down, and we almost got it, I think Friday when I woke up, it was right here at around 470. I was like, this is great. We got the dip we wanted. We're going to win the trade. But if we look bigger picture at IQ, we're going to see that RSI is very, very high, right? If you look at this number, once I move my mouse away, 74.98 on a 1-year basis. That's a very, very high number. Now, that's one piece of the equation, right? Because you could have a stock like an AMC or a GameStop where RSI could get super high, but there's precedent for it going much, much higher. With IQ, we were pretty comfortable that this was a decent place to start playing it down. Why is that? And the answer is because previously, if you're looking at the 1-year chart here, this is 1, where you get this overbought RSI from. 2, you've got spiking implied volatility. And 3, there's a little bit of precedent back here in the beginning of March and the beginning of April for it falling back down off this 560-ish, 565-ish level. And that's almost where it's back up to, right? We think that when RSI gets this high, it has a tendency to fall back down. On the 180 day, it's still a little bit elevated, but I think there's a long way down for it to come, and there's a lot of premium on it on a week-to-week basis, right? So we talked about Beyond a second ago where we sold a 13 strike call. We did so for 25 cents a premium. That's a 13.25 break-even price. Now for IQ, we sold a 5 strike call for 21 cents. That's a 5.21 break-even price. But if you look at what happened to us on Friday, this 5.21 break-even price, where if I remove this drawing, go to 5.21, it went above that for us. But the great part about this is we could just hold on tight. We know what our break-even price is. We started this with a half-size position, meaning we could afford to double down and increase that break-even price. But really, with riskier positions like these, and since these are naked calls, there's a little bit more risk. I think it's best to just kind of hang on and don't use that second bit of buying power unless you absolutely need to. I'd hate to blow it Friday morning and then have to roll 20 contracts into the next week. So what we ended up doing was, we sold 5 of these for 21 cents a premium. We bought to close for a 19-cent debit, and then stepping forward a little bit here to what we've got for next week, we then sold these, where did IQ go? For a 45-cent credit, right? So we closed out for 19 cents. We sold for 45 cents. So we made 2 cents on the initial ones, which we opened for 21, closed for 19. And then we sold new ones for 45. So that 2 cents of profit on the first, plus this 45 cents of credit that we got on the ones that we have expiring this Friday, puts our break even up to 547. So without even increasing our position size, right, we've taken our break-even price from this level, 520, up to 547 right here. And that's the beauty of rolling these positions for a credit. And the great part about this, too, is we'll remember that in our initial position that we had from the back end of 2022, our max profit on this was $210, right? A 21-cent credit across 10 contracts. Our max profit on this now is this $20 of profit we've already locked in and 450 more, which Google Finance is being weird, but that now takes it up to $470. So we get two things that are advantageous to us. We roll up our calls, or we roll the calls out, meaning we have a higher break-even price, so even more of a cushion. And two, since we got a credit for doing so, we now have even higher max profit at the same level that we had before. So it's kind of a win-win in that situation. And since we were patient, we also get to wait around a little bit, and we still can potentially double down if this keeps running away from us. Now, something to keep in mind is on a 180-day basis, it looks good. 1 year basis looks great, right? This 560 level, if it gets up there this week, I might think about doubling down, but pretty solid precedent for it to fall back down from there. But on a 3-year basis, this thing has been much, much higher. So we want to be a little bit careful, right? We want to pick out, okay, if shit hits the fan for us, so to speak, and then it runs back up past these points of resistance we saw before, what do we want to do? What's the next line that we're going to play it down from? And to me, that's around the $8-ish level, and that's why I want to hold tight. I don't want to have 20 contracts short at like 6 if it runs up to 8, right? That's going to be a little bit tough. And the good thing about IQI, or I guess IQ, you don't see anything up here indicating that it's hard to borrow. That's typically indicative of a stock that's very, very heavily shorted. I think if we go to AMC, oops, keyboard's not working, forgot about that. You'll see this big HTB, right? And that means it's hard to borrow. It means there's a lot of people borrowing shares. And those are the types of stocks that are susceptible to short squeezes, right? Bed Bath & Beyond, another one, you've got that HTB. If we look at IQ though, we don't see that similar indication of it being hard to borrow, meaning there's presumably less shares shorted, and therefore not as big of a risk to just go up 100% overnight. And that's the risk we run when we play these short positions like that. But if this trade goes the way that we want it to go, bounces back off of these levels of resistance we've identified, and let's see, usually we got a comment saying usually good to check with 3 Thinkorswim users, not all are treated equally with HTB and ETB. That's a good point. There are some people whose accounts are treated differently. But I will say, if it's not showing up on here for you as a normal trader, it's probably not that big of an issue, right? And another place that we could get some maybe reassurance is if we go a little bit further back on a 3-year. There's a big candle here from 17-ish to 24, but that was before, I believe this formerly was a SPAC and has fallen back down. You're not in danger of this big 5x overnight move, which is what we kind of want to make sure that we're not going to be standing in the way of if we're selling some naked calls, so to speak. And again, these are naked in the sense that, selling calls without shares is naked. But I will say if you open a similar position size as if you were selling cash secured puts, you're not maxing out your margin. You can afford to go short on the shares. That's a little bit more manageable. Now, if we had sold 100 of these and, equivalent position size, if we had sold cash secured puts was enormous, that's when we want to step off the gas a little bit and say, okay, let's not make any of these short positions any larger than the long positions. But that's kind of what we did for last week. And a good example of how I think we could target some of these a little bit more in the future. For some bearish entries. And now you may not agree with the stock on us, but that's the type of idea and the type of position we want to have in our account. Selling some calls on things that we expect to fall back down based off of historical areas of resistance and increasing RSIs right here, as that's firmly in the oversold territory. Looks like futures are actually down a little bit, almost 0.5% right now, which might mean that 2023 is going to get off to a similar start as 2021, or 2022 rather. Already getting my years mixed up. That's impressive. Yeah, so they actually opened pretty high up. Things were looking very, very good when they opened, almost at 3,900, and since they've fallen back pretty significantly. So that'll be an interesting thing to monitor as the night progresses. But again, nothing we can really do until the market opens tomorrow morning. A very nice sip of water there. But that was last week for us. And that wrapped up what was, I think a 2022 that I would consider pretty successful largely. There was one very, very big mistake, right? If we go back to our yearly summary, and that happened back in January. I'll talk a little bit more in depth about that, but let's just round out the numbers of how we performed. We came in at a 3.01% loss on the year. And one of those things where if you told me up front at the beginning of 2022 that we were going to lose money, I would be like, that sucks. Oh no. But at the end of the day, we want to keep in mind that our goal is just to outperform the broader markets, right? I've always said that theoretically there's a time where we could lose money during a year and I would be happy. 2022 is a great example of that. And why is that? It's because we came in at 3.01%, but the S&P 500 and Nasdaq came in at negative 19.48 and 33.89% respectively. So they both had horrible, horrible years, meaning that we outperformed the S&P 500 by 16.47% and outperformed Nasdaq by 30.88% during the year, leading to this very, very nice looking chart. I will be the first to tell you that around January and especially around the back end of April when we made a couple larger mistakes, I didn't know if we were going to be able to outperform. But we adjusted the plan. We stuck to the plan that we adjusted, and I think we executed it pretty well. And that's not to say that we were perfect from May going forward and then that all was good and well. However, I think we still made decent progress. I mean, obviously we made good progress against the market, and we still did so while making mistakes. So while this does look pretty good in relation to the market, I think we could do even better. And we're going to talk a little bit about what we want to implement in 2023 to do even better, so to speak, and talk a little bit more specifically about that. But let's take a look quickly at some of our best and worst weeks in the market in 2022. It's, one thing if we have all these losses. It's okay to have losses sometimes, but I'll be the first to tell you that if you're not learning anything from those losses, then those losses are in vain and you're bound to make the same mistakes again. So I think a few big losses that we want to talk about are first and foremost in January, right? This first 3 weeks of the year, we basically flushed $40,000 down the toilet. And you can see objectively, the market was only down like 6-ish%. So the market finished lower from there, and then from that point forward, we recovered $35,000. So from February forward, I think we did a great job. However, let's talk about the sins of January to make sure that those are not repeated. And what you'll notice here, I guess, kind of spoiler before we go and talk about why that happened. Our account's 74.16% cash secured at the end of the day on Friday, 83.56 the week before, 86, 49, 55. These are the numbers we want to be around in 2023. If we go flip back to the beginning of the year, and I hit the wrong arrow there, we started January with 171.75% fully cash secured. If you go to the next week, right, we lost $8,500 that week. You go to the next week, 183 again, we lost 8.1K more. And again, this wasn't off anything crazy, right? This is a minus 1.8% week. This is a minus 0.26% week. And the week after this is a minus 5.79% week, which is a massive red week in the market. But we lost 23K after that, and that was the huge collapse the first 3 weeks of the year when I just did not even want to open my brokerage account, and I absolutely hated looking at all of this. But why did this happen, right? It's these big cash secured numbers, and where were those concentrated? First, you could see that we had 15 short 70 strike puts on Roblox. That was about 56.81% of our account fully cash secured. Our idea here was that we were going to sell something expiring in April for a 70 strike, and we were going to give ourselves a big cushion because if this hit max profit, right, it's 15 times 1, or excuse me, let me pull the calculator up so I don't just say something stupid off the top of my head, right? The idea behind this trade was that we'd sell 15 contracts, and at max profit, they'd make $380 a piece. So between January and April, we'd take home $5,700 on that. However, that turned into a much larger loss because when we looked at Roblox at the beginning of the year, we thought 70 was a decently safe price to target. And if we go back to the 1 year and we look at where this was, right, it was at 103 at the beginning of the year. So we figured if we could just sell something down at the 70-ish level, that's a decent level to have it at. If we back up to the 3 year, it traded at 141. It was decently stable around the 70s before then for a good 6, 7, 8 month period. So especially coming back down from 141 and hitting this, resistance again where it previously peaked. When Roblox was at 100, I objectively thought from a chart perspective that 70 was a decent place to get in at. And, that turned out to be wrong. So lesson number 1, and probably the single most important lesson, we've talked about this a bunch as we went through 2022, and it served us well in the back half, is that things can always get worse. And that's really the biggest driver behind our main strategy, which is starting smaller and scaling into trades. Yes, it kind of sucks sometimes if you start with a smaller position and it shoots up and you're like, oh, I could have made more money. But that's a problem you're having where you are making money, right? So the problems we have where we have money in our pocket are the good types of problems to have. Those are the good problems that we want to have in 2023, right? We want to be saying we could have made more, not that, oh, we got greedy and lost a ton. So that's what we're trying to avoid going forward by scaling into trades. However, I did the same thing with a firm the week after. So we at one point had 101% of our account in these two positions, and the Affirm was a 55 strike, very similar setup to Roblox, had previously IPO'd above that, had demonstrated support above that, and we just thought it couldn't go much lower. But again, big thing we want to have in the back of our minds, especially when getting into larger positions, and we're not getting into positions that large anymore. That's probably lesson number 2, is that things can always get worse, right? We thought that this level back down here would be a decent level to potentially play support off of. It had run up to 176, but here it is today down below $10 a share. And we've actually done a decent job chasing it back down. I think since March or so, we've actually made money on a firm despite it coming back down from 25-ish. So the ideas themselves are sound. Just the biggest issue with these was the position sizing and maybe a little bit arrogant assumption that things can, that the support level previously established is kind of the law, right? Because at the very thick of it, the very base thesis is that, look, if there were actually 0% chance of a stock going this low, the option wouldn't have any premium. The premium's there for a reason. We just need to make sure we benefit the risk reward and then make sure we have a plan B for if that risk is realized. But really, the big losses in January almost entirely attributable to that. We had Palantir, we had Fubo, we had DraftKings. Those all experienced pretty similar dips as well. But those were the two larger offenders right there that drug us down. Now, the good part about our strategy is you scale into these positions. Even though this got pretty high at one point, it bounced back a little bit at some point, and we were able to recoup some of these and get back. And then we had another just back-breaking week when DraftKings went from 23.33 to 17.29 over the course of a week. I think that was earnings week for us. That was disappointing. We also had a very long stretch in February where it felt like every single earnings report on a stock that we owned went poorly. But again, we scale in positions, it comes back. But you'll notice this theme, right? This theme of, yes, we'll have these big losses, but if we scale into these positions, stocks aren't going to go down every single week. They may go down over the long run, but it's the idea of RSI, right? If things are going to fall, and they could definitely go lower in the future. But if you have a somewhat bullish thesis, some of those drops can be pretty good opportunities to scale into trades. And as you can see, right, a couple big red weeks, but that's where our biggest green weeks are. Our biggest green weeks that we had in 2022 were after the largest red weeks, and that's by design, right? We lose 23K over a 2-week period. The next week we make back exactly 23K. That's the idea, right? We scale into these trades so that when they bounce back, we reap the rewards. Now, we adjusted our strategy, I think, at the beginning-ish of July to say, okay, look, it's pretty apparent the pattern that's been going on in 2022. The market goes up, the market goes down. When it goes down, we have these big losses. Yes, we get bailed out when it bounces, but we know that things can always get worse. They're not always going to bounce back up, but let's start a little bit smaller off the front end, right? Because even when we had some standard weeks, right, our upside was only like 3K a week. What were we putting ourselves at that much risk for 3K? You'll notice that, July forward, our standard-ish week, the average week, excluding the 10K week, let's be objective here. The average week here was $2,300, and that is perfectly fine to go forward with. And even if we want to include the big red week after that, it's still an average of $1,000 a week. So we were doing very, very well off maybe sacrificing a little bit of money up front, but doing that and having that risk trade-off prevented these big red weeks, right? We had losses of 23K, 20K, 14, 17, 9. And I think the biggest loss we had after that was this 12K loss in the week of September the 18th. And then after that, we didn't have a single week where we lost more than 5,308 or like $5,000-ish dollars, right? So let's go back to the September week really quickly, see what happened there. And then here it is. So this was an unfortunate week. And we talk a little bit about some unforced errors that every now and then we'll try to do something a little bit outside of our strategy. And then it sucks when it doesn't work. And it's just a very good reminder to stick to the strategy. This week of September 18th was a great example of that. Yes, it sucks that DraftKings went down this much. I think we relatively did what we were supposed to do there. We may have scaled in a little bit early on the 16.5p, but like that's $3,700 loss. It is what it is on that one. We lost a little bit more on TQQQ, and right, this is just what happens when the market drops 4.58%. And you'll remember in January we saw the market drop similarly to that, and we lost like $23,000 in a week and like 30K, 40K over that 3-week period. So even with the big mistakes, this is better. The biggest mistake we made was this right here, PGY, this 6-strike put. We got greedy with it. Don't know why we kept holding it. Don't really know why we got into it. It wasn't really a fundamentally sound stock. We tried for a little bit of IV reversion and got unlucky in the sense that they announced dilution the day after we got in. Now, this isn't me just sitting back, and I think this is an important distinction to make. This isn't, oh, this trade didn't work, it was a dumb idea. The reason this was a dumb idea is because of our position sizing off the bat. We started with 10 of these 6-strike puts, and because of that, we didn't really have a lot of wiggle room, right? We tried to add some 5-strike puts for 70 cents, but it went even lower than that. And, you know, when the dust cleared, we lost about $4,000. But in no way is this me saying we shouldn't have had this loss at all. We should have lost a little on this position. But if we started with the 5 of them and then scaled up to 15 as opposed to starting with 10, then adding 5, and then after dilution our hands are tied, we get screwed and lose $4,000. So I think maybe if we had played this a little more smartly, the loss is around $1,000 to $1,500, saves us around $2,500 to $3,000. And yes, we still would have gotten crushed that week, but again, avoiding losses are just as good as generating gains, right? Avoiding a $2,500-ish loss has the same effect of us making $2,500 back on something next week, right? So we want to keep that in mind, just smarter with these position sizes. We continue to make some mistakes, and I think one of the other big mistakes we made was with our management of the SPX 0-day call credit spreads to hedge. And I think some of our logic in the way that we went about that was a little bit flawed. And let me go back. We kind of stopped doing those towards the end of the year because of this. But you'll run into situations, right, where we like on 11/10, and I think the expiries here were on the 11th. We had a pretty good week. The market went up 5.89%. That's phenomenal for the market. We should be crushing here when that happens. We still made $3,400, but we flushed, what is this? The sum $1,800 down the drain off these call credit spreads on SPX. And the idea was that we wanted to hedge in case the market went back down, but let's really think about what we're doing, right? And this is where I took a step back and said, okay, even if these hit max profit, we make $300. And if the market falls back down, is $300 going to be that much in the scheme of things? To me, the answer is no, especially, you know, when weighing the fact that the risk of this is potentially what happened to us where we got stopped out and had to close out for an $1,800 loss. So I think a much better way to approach that is going to be with XSP, which we have set up. Where did everything go? There we go. Which we set up last week. We made $340 off of. We set it up 2 weeks ago. We made $556 off of it, and we set it up the week before that as well. Maybe we didn't. But we've actually started tracking that on its separate tab here, and I think it's gone pretty well. And there are a few things that I want to talk about for these XSP positions as we head into the new year, because I kind of want to eliminate SPX a little bit. I think credit spreads do have their place, and if I have a ton of conviction about the way something's going to go, you know, there are maybe a decent capital efficient way to play that. But I think the idea we had before on these one-sided hedges where we're just doubling and doubling and doubling, you know, it starts to really skew the risk to reward of that hedge, and I don't think that's the right way to go about it. So enter the XSP strangle. Backing up, what is a strangle? We sell a call, we sell a put, gives us a nice range of profit on a weekly basis. Now, this isn't so much of a hedge when it starts, right? But as the week progresses, let's say for this next week, right, we sold 376, 386, and we did it for a 425 credit. So if you go to Thinkorswim, we go type in XSP. What is XSP? It's SPX, the S&P 500, divided by 10. So it's smaller size. You're not going to be risking as much capital with this. So if we zoom into the 5-day, What we've done here, and I think we've already illustrated it, is there are two key areas to pay attention to with a trade like this. The first is your max profit range, and this is going to be anywhere between 376 and 386. Since we sold a 376 put, we sold a 386 call. If XSP finishes in the middle of those, we're going to hit max profit. That's going to be 425 bucks for us. Bingo. And that is going to be, I actually need to remove all of these. It's not letting me. So bear with me. Remove drawing. Okay, so 386 and 376 are going to be the two areas that we opened up our strikes, right? So anywhere between these two red lines for the next 4 days in the market, right? Because the market was closed today. We've only got 4 trading days this week. Anything between here, we hit max profit of 425. But the great part about this 425 credit we receive is that even if the price of XSP gets outside of these, guess what? It's not that big of an issue. Because if we go to our calculator, which is going to take me longer to pull up, this is just our max profit range. Our actual profit range itself, where we can make something less than max profit, is going to be 425 plus or minus the edges of these legs, right? So on the high side, it's going to be the 386 plus 425, meaning 390.25, which is all the way up here. And on the downside, if we go back to this, click around a little bit, it's going to be 376 minus 4.25, meaning 371.75, which is going to be all the way down here. So my approach to this is, unless we breach here or breach here, just don't touch it. There's simply no reason to. But if it does breach these, I think what I propose is starting to handle these somewhat similarly to how we did handle those SPX credit spreads. And that would be just to add one more of these. Because the idea here is that this is a couple percent above where XSP closed at on Friday. So if the market moves a couple percent next week, guess what? We are still within the range. But if it moves like 3 or 4%, it's probably going to start to get overbought a little bit from an RSI perspective. So from that perspective, selling another call, a bearish position, looks good from an entry point if RSI is getting elevated. And we've got a question from JRA, which I think is a good one in the YouTube chat, saying, why not do strangles on MES? If in the money you're assigned one contract, which is about $1,500 of margin, and then you can sell calls on it. It's also tax advantaged. I will say XSP is tax advantaged as well. But from an assignment perspective, you know, I could see the merit of it, right? If you want to do MES, very, very similar. Now it's going to take a little bit more money, right? Because this trades at 384. Maybe I'm saying that wrong because it's the contracts are of a smaller size, aren't they? It's not 100 contracts, it's one. But let's look at what that would look like, right? So if we take a look at January, the one that expires in 4 days, and we wanted to do something similar, we could go over here. You know, sell one of these for like 2-ish. Right, so it's 22, which you might say, oh no, this is scary, that's 2,200 bucks. But I think these are actually only, there you go, they're actually less than that. It's 110, not even 220. So you need to sell a couple of these to kind of have an equivalent of one XSP. But, you know, not a horrible idea there either. You get assigned the contracts. I don't hate the idea one way or the other. You're saying it's more liquid. You know, that could work as well. Let's check on fees really quickly, right? You know, 450 and then 44 cents. Let's type in XSP again. Come on, load for me. Let's see what the fees are on this one again. So if we wanted to sell like one of these, uh, 55 cents. So there's no futures fees on this one. You could charge like 4-ish bucks, I think, on futures contracts. So maybe that's a slight advantage of using XSP as compared to MES, and that also is going to vary from broker to broker. But I think they're pretty similar, unless, let me go back on MES really quickly and check if the margin's much better. That was the one thing I forgot to look at, as you mentioned, because this is also a decent consideration as well. So if we want to sell 2 of these, which would be the equivalent, Yeah, no, that's a great point. Significantly less margin required on those. So if you are running into buying power issues with XSP, which luckily we've, weighted our portfolio in such a way that it doesn't, we're not really bothered too much. But that is definitely something you could do. And I think another advantage from MES as well, obviously, since it's a futures contract, you could trade it right this second. So if something happens overnight and you're like, oh, I need to do something, XSP, you can't really do anything, right? It's more of a normal thing that trades during the week. But, I think that's a great recommendation. XSP, MES, very similar price action wise, but if you're having trouble with your margin requirement, MES might be a great way to go. So love that suggestion. I think they're very similar. But I'm XSP just because it's nice and easy. It's what I've been doing. And I don't really have any buying power issues at the moment. But that's the idea with the XSP strangle. And again, let's just put this in here. Or MES. Or MES. For those of you that have futures access. But we've run 2 of them so far. They've been very, very successful. And again, this is based off that higher collateral number. And if we wanted to use MES, which I think only took like 2,500 when we took a look at it a second ago, these returns start to look a lot better. But of course, that's just because you're changing the collateral. Nothing else too materially outside of that is changing. And that doesn't mean load up 4x the size of that because collateral is smaller, right? It means be smart. Just use that other collateral maybe to secure other positions. But that's the idea there, right? We set the legs using the expected move. We take 70. Oh, another good point I want to make that I didn't make is we want to take, if you have the opportunity to take 75% profit or greater early in the week, meaning Monday, Tuesday, or Wednesday, absolutely do that. Because the market could switch in the blink of an eye, right? If we go back to this chart that we saw on XSP, look at this. I mean, it basically moved within that range in like a 24 or maybe almost intraday on Wednesday. It moved in between that max profit range, looking historically. But the idea is, look, if it runs way up here and starts threatening this, just close your 376 leg. Because the last thing that you would want to have happen, and we've seen it happen in 2022 countless times, is to have it go all the way up here. You're worried about this leg so much, and that, if for whatever reason the next day the market drops 3%, all of a sudden your 376 leg, which you could have closed for like 20 bucks the day before, is in hot water and giving you trouble. So that is what we want to avoid. So take profit earlier in the week if you can, and you'll notice that we didn't let either of these first 2 expire worthless. We closed for 40 cents and 50 cents respectively, and still have been generating some very, very nice returns. And then again, if that leg is breached, and I shouldn't say leg is breached, I should say if the break even is breached, add a contract on that side. So again, if we get above 390 on XSP, we'll add another one at like 392, 393. And then anything at the end of the week that's still losing, luckily we haven't had to run into this issue yet, just roll it into the next week. I think from a macro perspective, what we're going to see for the next year or so, I don't expect us to run off to like 500 on the S&P 500 again anytime soon. So if you do get breached a little bit on the high side, just roll those things out, collect a little bit more extrinsic value, and then when it falls back down or when it comes back up, eventually that strike will be hit again. You just got to be a little bit patient, keep that buying power tied up, and just continue to roll things week after week. And I think these are going to work pretty well for us in the coming year. And again, these are a little bit smaller in size right now for us, maybe a little bit more experimental, but if these start to work a little bit better, we may take that suggestion from JRA, move into MES, and size up a little bit. We don't want to push it and go crazy, right? But we could definitely, if we have 2 or 3 months of doing this pretty successfully, I think that's all we will need to have the confidence to size in a little bit further. We want to diversify our strategy in the market a little bit as we head into 2023. So let me take one more sip of water. And I think probably about time to talk a little bit about 2023 further. I think XSP strangles, which I guess we cut ahead a little bit, were definitely one of the things that we had on the. And great point too. You can't get a sign on XSP, so it's a cash loss, but that is mitigated by just rolling into the following week. So that's the idea, right? You can't be assigned on it; it's cash settled. But the idea is don't take it to expiry and get assigned. Just roll it if it's a loser. And again, those are cash settled at 4 p.m. on the day of expiry, so there's no after-hour risk to even have to worry about. So that's always nice. But let's talk a little bit about 2023 and what we are going to be doing a little bit differently. We talked about some of the lessons that we saw in 2022, and I think in general, we're better off now, obviously. I think the dust has settled a little bit in the growth basket. I don't think we're going to see anything as crazy as 90% drops across the board in a lot of these growth names. So I think that contraction of values is a little bit behind us. I think what may be next up for us, right? Let's take a look at, actually, this is the S&P 500, isn't it? If we look at it over the last 3 years, we've seen it almost fall back down to this pre-COVID peak. We've seen a lot of these growth stocks fall back down to or below their pre-COVID peak. Square is a good example. Like a firm. It's way below all that. DraftKings is way below all that. But what's not quite back down to that level yet? Something like Apple, where the pre-COVID peak was at 80. Something like Microsoft, where the pre-COVID peak was at 190. We look at Google. I think Google's a little closer, right? Where the pre-COVID peak was at 76. We take a look at Amazon. Amazon is almost back down to the COVID lows at 81.3, which is why we're starting to scale back into Amazon. But pay attention to what's still inflated, because it's one of those things where I feel like it's only a matter of time until certain dominoes start falling. Some of the blue chip stocks like Apple, something like Microsoft, these are the ones that I'm worried about as we head into the new year, and they're so heavily weighted in the S&P 500 that I feel like, we may take another leg down, but it won't quite be at the expense of some of these like DraftKings, where we saw it go from 74 to 11, or a firm where we saw it go from 177 to 10, right? I think we have those kind of moves behind us, right? The huge valuation bubbles are mostly gone. Is there potentially room for it to still go down? Again, what was our first lesson from 2022? Things can always get worse. But I think the bright side here is, famous last words, right? I really don't anticipate we'll be fighting anything this crazy in the near term. But with that said, what was I about to talk about? Oh, it was our new sector-based approach for 2022. Or 2023, sorry. I wrote that down wrong in the agenda. But in 2023, if I refresh this, hopefully these numbers come back. Thank you. There are, I guess, maybe backing up a little bit. We always want to be a little bit more in line with the S&P 500. It was super, super frustrating in 2022 where we thought we were diversified in our portfolio, but a lot of our stuff kind of skewed towards growth or skewed towards one sector. So the S&P 500 could be having a good day, which was drug up by maybe 4, 5, or 6 different sectors, but none of our stocks were in those sectors, which of course, talking about our long-term goal, is a recipe for underperformance. So how do we avoid that? And to me, the answer is to be a lot more cognizant in 2023 of the different sectors of the S&P 500. There are 11 of them, and I've incorporated them in our weekly profit tracker just so we could be very, very cognizant of those and have those at top of mind when we add those to our portfolio. So as you can currently see, we've got the 11 broken out here, along with a breakout of what percent of our account is dedicated to each of them. We also have some nice conditional formatting here in column K to highlight any sectors in which we do not hold any positions. So if the market dips and we're looking for a place to potentially enter into, these sectors would be top of mind to further diversify our portfolio. When we talk so much about RSI, we also want to take a look at the RSI of those respected portfolios, right? So if we go over here, we've got the S&P 500 sectors laid out. We sort them by RSI. For example, energy is at 51.8. If there were a certain sector of the S&P 500 maybe not to get into right now, it would be this one. But XLY, consumer discretionary, has an RSI of 37.32. So that might be a good one to load up in. And as you can see, our portfolio is currently 24.22% consumer discretionary. So while this is a little bit larger number when compared to some of the other positions in our portfolio and other sectors that we hold, we're okay with that because it's sold off a little bit, along with technology, materials, and the overall S&P 500, which is right there. So technology, we have a position. Do we have materials? We don't have any materials, so maybe materials would be a sector that we would want to look at. And I guess just going right into it, let's follow that process through. How could we potentially find materials stocks that we could jump into if we want to add some diversity to our portfolio? So one really good way to do this is just start with our basic high ROR puts without earnings. And we're going to wait a second for those. That's going to bring in probably, oh, there we go, 651 different results expiring within a week. But now our question is, okay, how do we find the ones here that are materials? And the answer is to go intersect with, we go by industry, materials, and we click select all materials. And just like that, we go from having 651 different options to a list of 28, which are now in the materials space. And you definitely want to be careful, right? This is another situation where it's like, just because something is at the top of this list doesn't necessarily mean it's a good idea to invest in. AMRS is probably a very good example of that, because as you can see, it has a 9.09% ROR as compared to some of these other materials stocks, which are a lot different. But let's take a look at AMRS, see what's going on right there. 153, kind of bottoming out where it's bottomed out previously. This doesn't look horrible. It doesn't look terrible. I gotta say, did go down to 136. Is there any news going on right now? Looks like they registered a direct offering, so a little bit of dilution going on, but it would appear if that was, announced on the 29th, maybe not the worst thing in the world to get in now. I don't know. I mean, if we look at the weeklies, that's decent premium. That's a material stock. The market maker moves at 22 cents, suggesting that there's downside to like 130-ish, which this wouldn't quite cover. But if you can grab 15 cents on that, that's a pretty low risk type trade where you could potentially bag about 150 bucks right there. But more realistically, we get on the list, we go CLF, X. We know that those are steel companies, AA, Tech, FCX. These are the types of companies that you will potentially want to look to add if you wanted some exposure to the materials sector. And there's nothing wrong with a lot of these, I don't think, right? X is a normal steel company. Look at that. That's pretty balanced graph ranging from 27 to 23, closed at 25 on Friday. If you wanted to add something that's 1% or 2% or half size position, you'd get that at 25 or 24 for like 40 cents, gives you a 24.10 break even price. That's not bad on a 1 month basis, right? So X potentially would be a good thing to add if you wanted some exposure to materials. So that's just an example of how we would use that idea of diversifying between different sectors of the S&P 500 to guide our position sizing in our portfolio and guide, how we want to look and find new positions. So that's probably the biggest change that I think we want to have for 2023. And with that said, we've started, in my free time over the past holiday week or so, when I've had a little bit of time off of work, have been working to put together some charts, which I'm trying to find off screen right now so I can pull it up on screen while I talk about it. But just things that can help us a little bit more with compiling data relative to these sectors, right? Because we talked about wanting to add materials. Yes, if you click here, go to your option hacker, then put this in, and then intersect it with this. Yes, it takes a little bit of time to find those, but that's just one sector, right? There's 10 more, and quite frankly, I don't want to spend the time doing it for every individual sector, which means I don't want you guys to spend the time doing it for every individual sector. So what we have done, there we go, I finally found it. I put together some code that'll compile all of these RSIs here for us in a handy dandy 3x4 chart, or is it 4x3? I don't know. That's outside my expertise. But here we go, top left, you're gonna have the S&P 500, and then you're gonna have every individual one. And it'll change color if it goes above 70 or below 30, meaning overbought or oversold. So you'll be able to quickly identify that. And then goal is to, on a weekly basis, essentially distribute this chart with maybe like 5 to 10 names per sector, which have decent premiums. And then you'll be able to take a look at that, read through it. It'll have economic events, earnings calendar, and just kind of an all-in-one document. But shifting the focus towards the different sectors, the S&P 500, that's kind of the main plan right now for how we plan to attack that. So let's go back here, see what else I've got on my agenda to talk about. We've made some adjustments to the profit tracker, and I think we've pretty much already discussed that. If you want to hear the details about that, effectively, we've added this sector thing here. How does it calculate all this? It goes into sector, it looks it up based off of the ticker, and we have a hidden sheet on here where if we unhide, I have no idea where it went. Where's the hidden sheet menu? Sector ref, there we go. So basically every stock that we play is going to be put onto this tab. We're going to have the sector to look up. How do we look up the sector? We simply just go to Market Watch. We type this in here, and then what you can do is go to Customize, and then one of the columns you could have here is going to be sector, and it'll tell you what sector certain things belong to. So I just type it into Thinkorswim. It tells me. I put it into the spreadsheet here, hide this, Come on, hide the sheet. I don't understand. Oh, I think I accidentally hid the weekly tracker. Whoops. And then it'll pull it in here and then basically runs a sum if saying if something right here, one of these tickers says financials, which it does for one of them right now, then sum up this right here, which is our portfolio allocation. So that essentially is going to give us what percent of our portfolio is allocated to each respective sector and hopefully give us a more balanced approach for 2023. And that's how we plan to accomplish that. Another thing that we want to talk about in line with the scanners is I think I finally have figured out the old IV reversion scanner, and I'm excited to share that really quickly. Basically, before, we know what an IV reversion type trade is for us, right? It's an example of when the stock shoots up a bunch off good news, presumably, and it shoots up so much off of the good news that implied volatility also increases, and that implied volatility increases so much so that the put premiums actually end up increasing. So a good example of that is Bed Bath and Beyond. Nye in the YouTube chat. Appreciate the comment. Thanks for watching, and I hope you enjoy the updates we got. But a great example of this is Bed Bath and Beyond, right? You see a huge spike here from, what was this, like 462 up to like 27, and it, implied volatility went up a ton. It went from like this 1.53-ish level to 3.04. And really, the impact of this surge in implied volatility that we see here is that even though the stock was running up and up and up and up, even when the stock was trading at like 20-ish, you could sell puts all the way back down at this level for decent premiums. And we were able to kind of get in and get out and scalp in that manner. Now, the other important part about this is if the stock continues to run up and then implied volatility dips or implied volatility dips, period, and you're able to take profits, you do it. These aren't long-term investments by any means, and that's demonstrated by where Bed Bath & Beyond currently sits. But when these things spike and implied volatility consequently spikes, there's some very, very good opportunities. Up until today, we didn't have the greatest way to scan for those. I think if we pull over our Discord server, I'd kind of taken it down for a little bit over the holidays, but we have this IV reversion alerts. So anytime that the alert that we had previously set up was triggered, we'd get an alert here. And if you want to sign up for these alerts, you basically just go to premium announcements and you click one of these emojis. And as I bring this up right now, I realize that's probably a little too circuitous of a process. So I'll update that as well. But that's where it is right now. If you want to receive alerts to your phone for these, for either when stocks are halted or for when IV reversion occurs, that's where you do that. But the idea here is you're not going to have to sit here and watch your scan all day. It's going to send an alert to your phone for when this is identified. Now, the issue before was that we didn't really have the best way to identify those opportunities. Kind of the best we could do was put together a scan of a few different things that we knew were characteristics of when an IV reversion opportunity would present itself. But we didn't actually have a scan to pick out this kind of a thing until I took a little bit of time over the break and finally finished out how to write like ThinkScript for that. So what we have now is this stock query for IV reversion, which has all of this formula in here and is going to pull up exactly what we're looking for, right? So for example, BBP, that's the top of the list. If we go to BBP, what we're going to see is essentially a pretty big jump in implied volatility. Now, these are very, very low volume stocks, and this is part one of the scanner, so this would not be an actual result. But the idea here is it picks up these spikes in implied volatility, where it goes from 0.2 to 0.3. Objectively, that's a 50% increase in implied volatility. More realistically, that's probably a product of low volume and spottiness of the stock. So this probably isn't a great example, but this has options. However, since there's no volume, there's no volume on the options. So instead of using this as a stock hacker, what we do is use an option hacker saying, okay, we've got our basic high ROR puts without earnings. We remember that if we pull this up and we scan for it, what are we going to find? We're going to have 651 results. But let's actually intersect this with our personal IV reversion stock scan. So what this is going to do is effectively put these parameters, right? We've got this scan, but we know some of these stocks suck, right? BBP, it's garbage. There's no volume. If you go to BCLI, probably very similar story. BCLI, pull it up, a little bit more volume, but look, I mean, that's actually kind of decent. Implied volatility spikes up a little bit. But if you go back on a 1 year basis, it's actually decent. But the issue here is these expire in 18 days, right? We remember that the IV reversion trade, it's a quick in, it's a quick out. That's not going to work for us. So we don't want that one to show up either. So we go to the scan and we basically have the option hacker, which gives us options that we like, basically options that are one, out of the money, and two, offer more than 1% ROR, three, have decent volume, and expire in the next 8-ish days or so. So we run that scan, and then we intersect it with this so that we know that we're getting stocks that have this, rare implied volatility trait that we're looking for. Right now, there are none, and that's not discouraging. It's a good thing. In fact, I think there were way too many results we were getting before. So we're comfortable now and confident in the fact that if we do start to get alerts off this, where we take our normal high ROR puts without earnings scan, and then add in our IV reversion stock scan, we're going to get a very, very good list of results. And now that I think this through, I may want to tailor this a little bit more to make this a little bit broader so that we just ensure that there's volume, period. I don't know if we necessarily need to target some of these other things like earnings. But this is the idea, right? We have this nice scanner which now identifies these changes in implied volatility. And to be clear, this does it anytime implied volatility on a 1-day basis increases more than 35%. And you can see right here, if you look at the vol index and have that pulled up on your scanner, you'll see something like THCH. You can see, okay, well, this one has a ton. What's going on here? TH, if I could spell, THCH. Good Lord. Big spike in implied volatility, but it's kind of normally this high, right? So this isn't really anything to write home about, right? What we want are these huge spikes with option volume. And again, this one gets thrown out. It doesn't count because really there's no volume, and that's kind of what's causing a lot of the lumpiness in that chart on THCH. So again, this will have some results, and then this filters those results down to make sure, yes, those first ones are good results, but to make sure they really have what we want from the perspective of an option seller who's going to use this IV reversion approach. That is what we will be doing. So I'm excited about that. That bot is going to work, and hopefully we get a couple results that we can mess around with this week. Another maybe more devious idea that I have related to that is to do something similar, but take out the parameter of, because one of the parameters is that the stock is green, right? We want the stock to be going up when this happens. Because if the stock's going down when this happens, it's probably because something very, very bad has happened. And there is a time and a place for that if you really want to get into the volatility selling game, which isn't a bad place to be. But typically, I feel like we've made the wrong decision on those types of trades. But maybe just to stay alert to some of those types of things, it might be a decent idea in the future. I'll think about it. But I really don't want to, it seems like a Pandora's box kind of thing to open up that opportunity, because we've already demonstrated a few places back in 2022 where that type of a trade kind of bit us in the ass a little bit. But with that said, that's one scanner that we're going to try to take into 2023 to give us some more ideas. We've made those adjustments to our profit tracker that we've talked about a little bit. We're taking a more sector-based approach. So let's just talk about our plan for next week, right? We've talked conceptually a little bit about what we want to trade, but at the end of the day, we're comfortable. Our core strategy is working pretty well. We'll remember when we summarized 2022, right? It sucked that we lost 40 grand basically in the first 3 weeks of the year. We dug ourselves a massive hole. I'm confident now that our portfolio is sized as such where we will not do that. But even looking from that point forward, right? We made this point earlier in the stream. Even with the red December, if you take away the first 3 weeks of the year, which I know we can't, but if, for purposes of evaluating our approach, we made $34,000. And that isn't because the market went down a bunch in January and recovered. The market after those 3 weeks, the S&P 500 ETF SPY was at 438. It's currently at 382. So it's basically dropped 50 points, about 12%. NASDAQ was at 13,000 and it's down near 10,000 now. So it's not like the market bounced back up and we bounced up with it. I think the approach that we've adjusted and are using moving forward is a very fantastic, effective way to combat this kind of a market. So we're going to stick with that. We do carry some DraftKings shares over and some TQQQ shares over. I was kind of on the fence about this one a little bit. Like, hey, do we want to just start all of our positions over because it's a new year and not have, the sins of 2022 leak into 23? But at the end of the day, I think our process is our process. I trust our process. And I trust that these eventually will bounce to a point, whether it's 11.5 for DraftKings this week or 17.5 for TQQQ this week, we'll bounce back to a point where, they'll be called away and it'll look really, really nice. And if that happens this week, fantastic. I would love to take home, a little bit over $4,000 to start off the year, which would, that'd be a far better start than we had in 2022. But with that said, look, futures down 0.2% now. They're moving all over the place to kick the year off. So that'll be interesting. Couldn't even begin to tell you where I think things are going to land on Friday. A few dates I think we definitely want to pay attention to. Let me see if I could find it here. Economic calendar. Where did it go? Let's see if this is the one. This is not the one. But on Wednesday, we should have some pretty interesting stuff going on. We've got PMI at 10 a.m. and then we have the FOMC minutes at 2 p.m. on Wednesday. So keep that in mind. Those are two potentially volatile things. FOMC much more so than PMI. But then Thursday, we're not quite out of the woods yet because I think we've got some sort of jobs reports, or is that Friday? It's Friday. We've got non-farm payrolls and then non-manufacturing PMI. So kind of two big things, right? Is the Wednesday PMI at 10 a.m. Bigger than that is going to be the FOMC at 2 p.m. on Wednesday. And then Friday, one of those things where, yes, there's a lot of data on Wednesday, but you're not quite out of the woods yet because Friday, non-manufacturing PMI and a non-farm payroll report potentially could move the market even further. So with that said, we want to have a little bit of cash in our back pocket to spend just in case things get worse, right? If things go well and the market runs up, fantastic, right? This is probably going to hit 11.5. This will probably get back up to 17.5. I don't know what IQ is going to do. I hope it goes back down where we can make a little bit more. But if the market runs up off that data, guess what? We're going to be looking at just under $5,000 of profit. Fantastic. That's only using 62.59% of our account, and I will be more than happy to not lift a single finger on my trading screen throughout the week. That's the ideal week. But of course, things can always get worse, right? So we've got 20-30% more of our cash that we're more than happy to put into play. We've got our respective break-even prices over here. We've got decent cushions headed into the week, so I really don't think there's too much of an issue as things currently stand. Now, if these break-even prices start to get a little scary, okay, we'll maybe scale back in. We'll remember that we don't have anything in materials, and there's some good opportunities potentially between CLF or maybe something like X, where if the market drops down a little bit, that's where we might scale into after that. But with all that said, love where we currently stand. We benefited a little bit from a run-up at the end of the day on Friday, right? We rolled our positions back when DraftKings was at 11.15 and back when TQQ was at 16.7. So those run-ups are helping the profitability a little bit that we're seeing right here. But again, long time between right now and Friday afternoon. We just can't always, we're always super excited and cannot wait for Friday afternoon and when we get these things rolled into next week and lock some profit in. But I think we're set up pretty well. Lemonade, we've just kind of been chasing this one down a hole. I mean, this one's kind of funny because the stock objectively has been very, very poor while we've been playing it. And I think if we go back to the 22 tracker and go to the bottom of this one really quickly, another good example of how scaling in and rolling down positions is very, very useful. Lemonade, when did we start with Lemonade? I guess we started the week of 12/18, right? And we started this week with 14.5 strike puts. I think Lemonade was trading at like 15-ish, so 15 plus. But we made 120 off of it that week. Last week, we lost 250 and then made 120 off of it back. So we're down 10 on Lemonade, even though it started above 15, is now just above 13. And now as long as it stays above 12.5, we'll make 200 back and be profitable on Lemonade over the last month, despite the fact that the chart for Lemonade looks like absolute garbage over the last month. We've had bullish positions and we're in line to make money off this chart. That is how effective this strategy is, and that's one of my favorite things, and this is why we do it. Charge point, we kept riding this one, right? This is one where we talk about RSI. We loved where the charge point RSI got. We'd been watching it for a little bit, finally dipped down into the blue. Why do we love taking advantage of stocks that dip down into the blue? Because when they do, they usually rip back up pretty quickly when money starts to come back into the market. That's exactly what we saw. So while it's not quite anywhere near back where it was, at the beginning of December when it was basing around 11-ish a share, we got in back down here at 850-ish. It's back up to 950. So long as it stays above 9 this week, we're going to bag an additional, $220 of profit. One other thing now that I'm like thinking through all of this, and I think I forgot to mention it in 2022. One thing we also want to do a little bit better of a job of is taking profits early in the week. I cannot tell you how many different weeks we had in 2022 where on a Monday or a Tuesday or a Wednesday everything looked great and we had things that were holding out for maybe like an additional $100 per position. But come Thursday or Friday, whether it be bad data, just something crazy happens in the market and there's a big dip, we go from a bunch of winning positions to all of a sudden a bunch of positions which are not only losers, but we need to scale further into. We have a bunch of messes that we need to clean up. The worst thing that could happen to us in the strategy is going from a winning week to a losing week. So if on Tuesday a lot of these prices are still elevated, which again, futures are down about 0.25%, tough to really say what's going to happen from there. But if those things do remain elevated, I'm perfectly happy on Monday or Tuesday to start taking profits on some of these. And while I may leave $200 or $300 on the board, let's think about it. If we're able to lock in anything near $4,000 a profit, what's sacrificing $200 or $300 to lock that in a few days early? And if the market keeps running up and we regret it, oh well, right? We're going to regret making money. It happens. But if the market drops back down, not only did we save our ass from the market dipping, but we now have all of this money back in our pocket, which we can redeploy and then enter any of these positions again and try to hit them for double the profit in a week. So that is something we need to do a lot better of. And I know there's a very specific instance of this back in December when we had that good CPI number finally, and the market was up like 2-3% in the morning. And I think it ended up going red by the end of the day. That was a tough one to stomach, just opening your account, seeing a ton of green in the morning, and then losing money by the end of the day. But we're going to avoid such setups in 2023. Don't be greedy. Take money off the table. And I know at least with TD Ameritrade and Thinkorswim, any option you close for under 5 cents carries 0 commission. So unless you've sold something for like 10 cents and 5 cents is like half of your profit, it's probably a good idea just to set, buy to close orders at the beginning of the week that last about 3 days at 5 cents for each position. So if any of those hit those, you're good. You're out. You don't have to think about it again. And, the flip side of that is you don't have to wait 3 days to take home $50 of profit, which isn't necessarily, which isn't necessarily guaranteed. So that's where we're currently sitting, and that's a difference in approach that we're trying to take. And I'm really happy with the way that we currently have those things set up. So we're decently, diversified across here, because again, the point we want to make is like, say you have a firm in your account and you want to diversify. I'm going to go add another stock, but maybe you add something like Upstart, which is like the same thing. So just because you have multiple stocks doesn't mean you're necessarily diversified, especially if they're all within that growth bucket, especially if they're all within the same sector of the S&P 500. So I think increased diversity across sector in the S&P 500 is going to lead us to a little bit more success in 2023. But this is what we've got. I don't really see a need to add much more. And one more point I want to make about sectors is you might say, HT, you talk about sector diversity, but you have 1, 2, 3, 4, 5, 6 different things here where you don't have a stake at all. So if we go here, why is that for some of these? And I can tell you right now, if we look at utilities right now, let's go to our scan. Let's go to the option hacker and let's intersect it with industry, utilities, all utilities. Let's scan. There's no symbols that come up. So some of these sectors are inherently low premium, and that's just the way it's going to be. So utilities, if none of these are even registering at the beginning of the week on our high ROR put scan, we're probably just going to leave that alone. And just because we don't have exposure to utilities, there's still other places we could jump into. Healthcare is maybe a little bit hit or miss because we know that some biotech type stocks are a little bit too volatile for this strategy. So that might also be an area we back off a little bit. But having exposure to 9 other sectors across the S&P 500, I think is a great way to do it. So that's our approach. This is what we've got set up. We've talked a little bit about something like XSP down here, which is a new approach. We're starting to mix up the types of option selling that we're doing. We've talked a little bit about carrying some of these positions into next week. We've run the wheel with Amazon. We've got a bearish position in IQ, which we talked about at the top end of the stream. That one moved against us a little bit last week, but we still locked in $20 profit last week and have potential for $450 this week, so long as it stays, below 5 or goes back down below 5. But with that in mind, I think we've got a really solid setup. Nice to finally wipe the slate clean. I know that our goal in 2022 was to get back profitable. And we didn't do it, but I don't think we should lose sight of the overall goal, which we accomplished, which is outperforming the overall indices. And we're wrapping it up, so let's go back to full screen here. I'm really excited to start things over in 2023. And again, even though we didn't accomplish that goal of being profitable, that would have been a very, very good goal to accomplish because 2022 was a historically tough year in the market. I think we've got a lot of exciting things we're doing for 2023. Between the sector-based approach, between incorporating things like SXP or MES, the futures contracts, into things like strangles on a week-to-week basis on the indices. I think taking that sector-based approach, using our scans and using things like IV reversion scans that we've developed over the break, I think are really going to be helpful as we head into 2023. There's diversity in positions and there's also diversity in approach, right? We can hit the typical HT wheel. We can hit these strangles. We can hit the IV reversion and have, 3 different avenues of making money in a given week. So while they're all option selling, there are different types and styles of option selling we can use to diversify the approach a little bit. And I think all of that is going to come together to culminate in really what we saw between February and December of 2022, which was some decent profit despite a downturn in the market. Now, if the market decides to turn around for us and go up, that the help is always appreciated from the market, but don't expect it's going to make it any easier on us. But what we know is that we have an approach that we've demonstrated can handle this kind of movement, and we're going to stick to that in 2023. So for those of you who have tuned in for the first time, welcome, and for those of you who have tuned in before and are still following us, appreciate the support. Thanks for following us. And hope we can enjoy this ride together in 2023 as we attempt to accomplish our goal again of outperforming the market, and then hopefully this time actually make some money along the way as well. So until next time, this has been the Hourglass Trader, where as time passes, we make money, and hopefully we will talk to you guys again next week with a successful first week of 2023, seeing our diversity between S&P sectors play out, hopefully seeing some IV reversion alerts from the new alerts that we've coded in, and then having some successful XSP strangles and have all of that come together into this really nicely diversified and profitable portfolio. So again, thanks for watching, and we will talk to you again next week. Discord server, hourglass-trader.com. You can join that, and that's where we talk on a day-to-day basis and alert our trades. And that's all I got. See you guys later.